This event could not have been possible without the generous help of the following Platinum partners: Auction.com, HousingWire, PropertyRadar, the Apartment Owners Association, the San Diego Creative Real Estate Investors Association and President Bill Tan, the North San Diego Real Estate Investors Association, InvestClub for Women and Iris Veneration, Wholesale Capital Corp, New Western Acquisition, MVT Productions, and White House Catering.
I think I'll save affordability for a little later, but I do like to talk about that because it's a head scratcher for me too. But there's a lot of things that are potentially dangerous for real estate in the sense of policy changes. So it seems like we haven't talked about the budget for the country for a while. We've had a lot of diversions, but it would seem like real estate would be a prime target to take away some goodies. So if we're trying to balance the national budget, you'd have to think real estate is being looked at saying, okay, what can we take from this industry? So I guess I'd like to some input on, maybe Doug, we'll start with you. What are you concerned about any of the pieces that we consider valuable, like interest rate deductions or debt forgiveness, you know, those type of things? Are we going to continue with what we've got, or is it going to change?
Well, I'm bad enough at forecasting interest rates. Forecasting politics is that's a whole different ballgame. So what the first thing I think that needs to be considered seriously is the degree to which we've lost our fiscal or financial flexibility as a country, and it's a serious matter. The Social Security, Medicare, and Medicaid will be bankrupt in the sense that there's any reserve fund off of which the payments to recipients comes. Those will be exhausted and will come out of general revenue within a decade, roughly, on average across them. So that's something that we will have to deal with. So there's various ways of doing it. Social Security is actually the easy one. You could make that solvent for 50 or 75 years by moving the retirement age back gradually a couple of years. Doesn't have to go a huge distance. But even that, Washington can't get the traction on getting serious about. So where is housing vulnerable? Obviously, the mortgage interest deduction is things that people talk about. I don't actually think that you would get much revenue if you eliminated it. What you would do is affect house prices, and then people would alter their behavior and change the amount of debt and equity that they use to affect that. Plus, one of the things that's not well known about that is that the low-income households actually don't itemize, and so they don't actually use it. So there are some things to think about there. I think that the deductibility of debt forgiveness will probably get renewed in the meeting after the election. Congress will convene, and I think that'll be part of a package that's likely to be renewed. But maybe not. The other things, the deductibility of state taxes at the federal level is something that probably would get looked at. I would say if they were going to really go after something in real estate, they would eliminate the deductibility of second mortgages and possibly cap or lower the limit on which, but that's speculation on my part. I don't know of a proposal to do that today. Okay. And any other opinions on that?
I would agree that, you know, they have looked at it in many different ways. You know, they've looked at it as lowering the cap. They've looked at taking away second home deduction. They've looked at doing away with the second mortgage deduction. They've looked at a lot of different things and made different proposals, but nothing has really been voted upon yet by either body. You know, the outgoing chairman has put together a tax proposal, but it's not going anyplace because he's going out of office. So, you know, nothing's going to happen in the.
Washington calls it a tax break for the rich, and right. So when does it come into play? It comes into play when there's a debt ceiling crisis, right? and it comes into play when there's budget fights. So yeah, I agree. I don't. An MBA advocates obviously for everything remaining the same, but it doesn't. That's where when there's a little spark of fire there, that's where the spark starts. But it seems to always die down, and they seem to always move on to something else. And I would expect it to be that way.
We also agree that the mortgage debt forgiveness will be voted on and will be approved.
That should go in lame duck,
during
right?
the lame duck session.
Yep, absolutely.
Yeah.
Yep.
Now, do you think at some point that will be a moot point because you really won't have enough people upside down to worry about?
Well, I mean, Doug probably, I'm not going to give statistics because I could get shot for that based on the prior panel, but, hell no, I'm not going to say. You'll never hear one number from me the rest of the evening. But Doug, why don't I give that one to you?
Things tend to never go away in Washington, would be one way to think about that. Yeah, they just kind of move around. Yeah. So at some point, the market will normalize. That is, supply and demand characteristics will get back in balance. The house prices will move at their long-term annual average, which is about 4%. Adjusted for inflation, it's about 0.5 to 0.75%. And you'll have very low levels of delinquency and foreclosure. So the number of households that would be impacted by that will not be politically important, and then they might let it expire.
Yeah, it's probably got another 2 years, almost like TRIA. It probably has another maybe 2 years to be relevant.
Okay.
So it'll get passed here in lame duck, and then we'll deal with it again this time next year.
Well, what's interesting is
I was just going to say, we still have 1 million homeowners in California underwater, which is about 12%. And we're only selling 400,000 homes a year. So even if we went to sell all of those homes, it would take 2.5 years and sold nothing else.
that's why we can't build new homes, Sean. There's too many of those.
Part of it.
Okay. That was tongue-in-cheek, sorry. What about the one that actually really confounds me that exists, and that's the $500,000 free sale if you're a married couple every 2 years? I mean, that was a coup that I couldn't believe it happened. I actually had to make a phone call to someone smarter than me saying, am I reading this correct? Because that one seems overly generous, and I just took advantage of it, so I'm not complaining in the least. But I guess, do you think, is that up for grabs, or you think they're just going to ignore that one too? I guess no one, I just think real estate's a target to say, we're going to take some of your goodies, and I just don't see that you guys think that's going to happen.
It's a target if they really get serious about, changing the entire tax code.
Right.
If they decide to do that and really get serious about it, then everything's on the table. But
Right.
piecemeal, no.
So you would think if the Republicans take the Senate, there's a possibility of real tax code overhaul.
It still takes the president's signature.
Who?
Yeah, who?
Okay, I've been chairman of MBA for 4 days, and I'm about to get fired from a non-paying job. So if there's media in the room.
A few years ago, a group of investors were invited to speak with Fannie Mae, and I left that meeting feeling that the room was convinced that they would not have a job in a certain period of time. And I'd have to say that sentiment has changed, and I guess I wanted, Doug, your opinion of what will the financing in the future look like? Is Fannie and Freddie going to exist the way they are? Is it going to be downsized or changed? Or was it going to be business as usual after a little bit more time?
Well, when people ask me how I'm doing, I say I'm being conserved. So, conservatorship has sort of a relationship to preservation, I suppose. The questions you have to ask when you think about reforming the secondary market are, do you want there to be a 30-year fixed rate, level payment, prepayable mortgage? And if you do, that requires certain structures in the market. And those structures exist largely because legislation has created boundaries that allow institutions to earn returns sufficient to deploy capital to make that happen. So that doesn't mean that institutions named Fannie Mae and Freddie Mac have to exist, but part of the infrastructure of those two companies is what makes that 30-year fixed rate mortgage exist through what's called the TBA market, the to be announced market, which allows lenders to sell forward the commitment to deliver mortgages with fixed payment kinds of characteristics. So you have to decide, do you want a 30-year fixed rate mortgage? And I think the consensus in Washington is 90 to 100% that yes, we want to provide Americans a 30-year fixed rate mortgage. Okay, well that presupposes a TBA market. Then you ask the question, what makes that function? There's certain kinds of plumbing. And who owns those plumbing? You can argue about who owns those plumbing. You can move that around and how the pieces connect to one another. So you could take the companies apart, but a lot of what they do has to exist in order for that 30-year fixed rate mortgage to exist. The other piece is, does the government want to be involved explicitly or implicitly? And I think there's actually a fairly close to a consensus in Washington that there should be an explicit insurance premium on the tail risks, because we know that in a great cataclysm, the government will step in anyway. Mm-hmm. So let's get an insurance fund in place against that eventuality, and maybe it will reduce the likelihood that that would happen.
What percentage of loans right now are funded with some government program? I mean, is Fannie, Freddie, FHA, VA?
Somewhere in the 85 to 90%. No, yeah, the 3 rules of forecasting: if you give a number, don't give a date. If you give a date, don't give a number. And then if you get it right, don't look surprised. So, so I didn't say that number. So 85 to 90%, something like that.
Okay. What are the holes in the mortgage market that you'd like to see filled? Anybody?
Well, it's everything, it's the private label market, right? So private label market that's non-existent today. And as long as lenders are being fined billions of dollars, right, almost by the week, who is, there's investors, I'm a banker, there's investors, professional investors in the room, who in the hell is going to put their money in a system that at any moment from any government entity for, any reason that you're going to get fined billions of dollars. So you can't measure the risk. So as long as the penalty phase, and the speech I made Monday as chairman of MBA,
which I listened to, by the way.
Thank you. We called for the penalty phase to end, because that is the only way for the markets to recover. The penalty phase must end, and that we are emphatic about that. So,
what percentage of the market did the private label have at its peak? And I guess we're probably never going to head back there, but there should be a certain type of product that it can responsibly handle. So what is that product? What's missing? Is stated income, would that be one of those pieces?
These fellows would know better than I, but I really don't see in any viable fashion the private label market coming back for at least 3 more years.
Okay.
I do not. I don't. Does anybody feel any different about that?
Sean, what's your opinion on crowdfunding as far as their impact on?
Get the government out of the way.
Okay, but is it going toward mostly investor type deals, or is it reaching into the occupant owner world?
Yeah, on the owner-occupant side, I really don't see it. The returns people are looking for there are nowhere near the interest rates that you can get from Fannie and Freddie. So, we're going to have to divorce ourselves of the idea of a 3 or 4% mortgage before we really get private money back, I think, into that market as well. So, I mean, there's two issues. One's a regulatory issue, and the other is an interest rate issue, right? So at the current rates, I think you need some sort of, federal backing behind that and some such solid guarantee of security that you're willing to take that low of a rate. If there's actual risk and it's not government backed, then you're going to demand a higher rate. And there isn't a market for that higher rate right now. And then you add the regulatory piece on top of that. Why would you make a loan to a consumer, private money? I would have backed up the truck and, raised every penny I could have to make a loan to anybody who wanted a home in 2009, right? Anybody who wanted a home, if they had just come off of foreclosure, whatever. Because at the end of the day, if they didn't make that payment, I knew, I'd be glad to take that product back. It was underpriced.
One of the things that happened to the market in California in 2014 that was unpleasant was the reduction of FHA's loan limits. So in Riverside, it went from 500 to 350. What was your feeling on that on a national basis? I know in Riverside it didn't help, that's for sure. And I guess even a bigger question is that an indication of a gradual slide on that number? Because it's still relatively high percentage-wise in relationship to Fannie Mae. So is there intention to lower it some more?
I don't think they're going to lower it more, no. What happened was we had too big of a footprint for the FHA loan program. And so, the government decided the regulators decided they needed to shrink that footprint. And so they made a lot of changes to FHA, of which, lowering the loan limit was only one of the items that they did. They did many other things that, shrunk the FHA footprint.
Okay. How did that impact builders, let's say, in California? Was that a...
Well, it along with, if you remember the tick up in interest rates, that really kind of put the brakes on what we felt was going to be a much stronger recovery. And we've been kind of bouncing around ever since.
Okay. Kind of lends itself to the affordability question. So I'm always... What's interesting about affordability, and you guys have all heard me speak about this, affordability as it declines is always accompanied by volume increases in real estate sales. Almost always, until you hit a magic number and then the market does something very ugly. So we had a affordability decline, and this time, and this is why I kind of take this seriously, we're 30% California, right? Affordability, that's about where it is. Historically, that's not low. That's still pretty high, and our volume in sales this time didn't expand, it slowed. So I guess I'd like to know if there's do you guys have a reason that's better than affordability decline? Because that, to me, isn't the right answer unless we are permanently saying no to a lot of people that we used to say yes to. Now that's a whole different calculation and ball of wax. Because now we might be saying, oh, we're at a price peak. Because monthly we can't afford anymore because we won't get a yes answer past here. So,
what's interesting to me is if you drive around many parts of Orange County, especially in the southern part of Orange County, the amount of huge apartment projects going up, that tells you what's really, where we're going, at least in this county, I think. They're saying, hey, we've got to build more rentals, not more properties for people to buy.
But those decisions probably were made 2 years ago because a building permit takes a while. And, if I looked at the foreclosure chart, I would have said that's a rational decision. I've got a lot of people that are going to be leaving occupancy of a home and having availability of a rental. So that construction had to hit a game plan a couple of years ago. I guess, are you saying that you think is that the new habit being formed, that there's going to be a greater preference for not owning something?
I think we've seen that coming out of this crisis. I think you see a lot of people saying, do I really need to own a home again? Or do I need to own one at all? And if we're pushing out people from forming families, that, leads to renting. They also like to live much closer to entertainment, to things to do, and close to work. And so a lot of that is driving that too. So when they might have gone to the Inland Empire and bought something that was very affordable, they're now deciding maybe to stay in the employment areas.
How different is the household makeup now? It used to be, you think, okay, well, household, that's a married couple with 2.3 kids, and how different is that now? And does that affect the ability to buy something because maybe the would-be owner is single?
Yeah, the triggers to buying a house are completing school, getting a job, getting married.
We're 0 for 3.
Having a baby. Or 2.3 babies. The share of our children who are getting college degrees has risen. So that means you're moving at the margin, you're moving the time they buy a house out. That means they're not in the job market for that time period, so that moves the time they get a job out. Then there has been a secular decline in the rate of marriage by age. In other words, the age at which people get married has been pushed out for reasons other than education and employment. And that, of course, then pushes out the age at which you have the first baby and buy your house. So we recently took a look at the American Community Survey. We were interested in this question of first-time home buyers. So in the 2012 American Community Survey, we pulled out those households that were between the ages of 30 and 32, prime first-time age, that were married, had a 4-year college degree in the house, had a child, and had an income above $95,000, which anywhere in the country pretty much gets you into first-time territory. So if you compare that to the same cohort of people back in 2000, so for 12 years earlier, they're something on the order of 10% less likely, or the share of them that have bought a house is about 10 percentage points lower. That's a big number. So we've been, as I mentioned earlier when we went and talked to Janet Yellen, we said today, demand weakness trumps credit tightness. Doesn't mean credit's not tight. You've talked about some of those issues. We're involved in that. But there is this move to apartments for flexibility. If I'm going to be changing jobs in 3 years, do I get a payback on buying a house given all the fees I have to pay up front? House prices could go against me. I want to be mobile. There's a lot of things going on in the younger segments of the population. And then Gen X, which followed the boomers, they're the ones that took the biggest losses in the foreclosures. They're a smaller age group, but that's the group that actually took the biggest losses in home ownership during the course of the crisis. Will they come back to ownership? We'll see.
Okay. How big a deal is college debt for people that, you said that was one of the factors that they got out of college, and this time do they have more debt, and is it blocking their ability to get a yes answer?
We believe it is. MBA absolutely believes it is. I don't want to, I'll break my own rule. Statistically, I believe a four-year, it's been done before, a 4-year college graduate is coming out, my understanding, with about $36,000 of student debt, which is statistically 3 times as it was back in 2005. So we see, if you take the QM rules, so you've got a tighter credit bucket, and today, Doug can give you the numbers, but I believe if you look over last decade, inflation-based, the a 30-year-old's income is less today than it was a decade ago. So you have a tight credit bucket. I think median income is down for that 30-year-old over the last decade, and their student loan has skyrocketed. And you take that combination, and if you talk to loan officers that meet with customers every day face-to-face all over America, they will tell you that student debt is an issue. Now, academia denies it, but the truth of the matter is it's a problem.
What's interesting, if you look at the chart, it's $1 trillion of college debt, but only 33% of it's owed by people under 30. The next 33% is owed between 30 and 40, and 34% over 40, which I found interesting. Because I always like to look at charts and say, okay, so are they having to re-up their education for the new job market they weren't prepared for?
Either that or they needed to buy food when they were out of work.
That was college debt?
Sure, you can use college debt to pay for housing and some of these other things, sure.
I didn't know that, okay.
If you're taking some classes, whether you show up or not. You know those people.
Apparently you do.
First-hand knowledge. I'm pretty familiar with that.
That would have never occurred to me, Sean. Another chart that's not telling me the truth. Son of a gun.
I mean, the National Association of Realtors feels that student debt's an issue, correct?
Absolutely.
Right.
Yeah.
Okay, our back-end debt ratios then.
It affects them.
Yeah, no, I know it affects them, but in other words, is that restriction changed quite a bit, and is that likely to change going forward?
Well, the credit box is so much tighter than it was, and until we get some certainty in the lending market, meaning, the GSEs, and finally we're getting, the rest of it in shape. But once we get all of that so that everybody knows what the game is and here are the rules, then we can go to play.
I probably then took that, for some reason I took that article as it's done, but it's not done. No. Oh, it's not done, okay. And how far away from that are we, you think?
Again, I think the GSE problem is one that, we've got to get through. The quicker we can, the better off we are. Unfortunately, I don't think it's going to happen very soon.
You had asked when the private label market would come back. I think that investors will wait until they know what the rules are on the GSEs before they're willing to commit capital, because one of the things you don't want to put out into the market is a story bond. And if you get close to where the boundaries are set, but you're just on the wrong side of them, you can lose a lot of money. So I think it's really important for the private label market to come back in order to fix the GSEs. And we're in favor of that, by the way.
There seems like there's a lot of dots that are connecting, and one of them is going back to employment, and what you just said is that 10 years ago, a 30-year-old was probably making as much money as they are right now. Their median income hasn't changed, and yet their bills probably have. So in that regards, when we talk about how wonderful the employment chart looks like, is it telling us the whole truth or partial truth? It seems to me, I look at the unemployment chart with a lot of suspicion, because I see a lot of people have left the job market and they're no longer counted. So
well, that and they're underemployed. The one, many of them that have jobs now. So, it doesn't tell the whole truth. No, you're absolutely correct.
I think, the bottom line is as we've been talking about, the first-time homebuyer market. We've all been in the business a long time. I'm almost 30 years, and the first-time homebuyer market has never been softer. And I didn't graduate from Harvard, but without first-time homebuyers coming into the system, the move-up buyers, the move-up properties are not going to move, and it really, the first-time homebuyer is the key to health in the residential real estate market. So, right? What's that?
Somebody said hallelujah. I guess that was.
It's true. There's no doubt. So until the first, and this is why FHA is so important, This is why it was important for FHFA, i.e. Fannie and Freddie, to responsibly bring back to 3%. So the key to the real estate market is the first-time home buyer, and we've got to bring in successful, responsible first-time home ownership back. And this is where you heard Julian Castro, the new HUD secretary. If you've noticed, his tonality is different, and it's promoting home ownership again. That's not a coincidence. So maybe it's heading in the right direction, but that's what has to happen, in our opinion.
So,
Go ahead.
So I think, on both, income and demand and some of these things and the participation in the employment rate, I mean, my whole career as a software engineer has been using systems to replace people, and we need fewer people, and that comes out as the stat of increased productivity. But, I think we're right now, even though technology seems like it's been with us for a while, it occurred, the iPad's only been around for 4 years. It feels much longer. We're at a pretty substantial rate of change right now. We're on the cusp of driverless trucks and driverless cars. That's going to put a lot of people out of work in the trucking industry.
It'll be really good for the car repair business, though.
You don't think we can get robots to repair cars if everything's in exactly the same place? Can't think we can get robots to flip burgers? I mean, that's where we're going. We're going to need fewer and fewer people going forward. And we have a population that's growing. And I think right now we are at the cusp of as big a shift as post-World War II or post the Volcker era. And I think it's going to be marked by not needing as many people to work. And I think that's going to require probably a different fundamental economic structure. Because if you don't need as many people to work, how do you distribute income? And there's lots of questions there. But I actually think that we're in a more structural issue on unemployment that is going to last decades and be the biggest change in most of our adult lives.
You and I have talked about this privately, and I've had a headache ever since. Thank you very much. I guess it would be a bad time to bring up immigration law changes then, huh? But let's talk about that. That's one of those things that seems like it got put on the back burner. It was on the front burner. Is an immigration law change probably coming in the next year, and what would that affect? How would that affect real estate?
Okay, good question. Go ahead.
I was just going to suggest that absent immigration, the U.S. birth rate is not replacement.
Right.
We actually have the best demographics in the developed world. It's only us, UK, Australia, New Zealand, and Canada that have, including our immigrants, we have growth in our workforce projected out through 2050. All the rest of Western Europe is in decline. Russia is a basket case, and Japan is the poster child. So, the growth in your workforce combined with productivity is what increases your national income. And so it matters to us. The argument comes in if you're in a district if you're in a congressional district which is low skill, and the immigrant population is low skill, you're going to be opposed to that because it goes right to the heart of the people that vote for you, right? If you're in a high-tech space which has high incomes and needs skilled workers, it doesn't matter, in each of these cases, it doesn't matter if you're a Republican or a Democrat, it has to do with what the base is in your congressional district. And then that does play, as Sean says, against the question in the long run whether or not we can produce jobs to employ any of these people.
I'll ask the question a different way.
Damn. I thought I covered that.
I think.
I thought we were out.
No. I think it's going to be obvious we're going to have an immigration law change at some point in the near future, and when that occurs, what will the impact on real estate be? Because when it happened the last time, that was in the Reagan era, was it coincidental that real estate did very well? Or did it have some type of impact, short or long term?
I actually think we're going to be able to produce jobs. I think it requires some changes in macroeconomic policy to make small business more attractive in terms of profitability, which will allow them to hire more people. And I don't think it was a coincidence. I think the demographic story, absent that, is less demand for housing.
Now, the senior group, we talk about demographics. And I know you do a lot of this, asking groups questions. Have you asked them what their intention is? Do seniors generally say they're going to stay within the area they already are at? Do they intend to move somewhere else? And what would be the reason for that move? Do they intend to downsize and present the current house on the market? Because that would affect the builder considerable. So where do the seniors stand, and what is the age range they make this decision? I'm not asking anyone directly, I'm sorry. Well, I'll talk to, the builders. I mean, the builders have to look at that demographic all the time because they probably have to say, okay, we have a chance in Florida, let's say, to build senior projects. And I know there, I'm looking at those projects, and they're 2-bedroom with 2 master bedrooms. They're intentionally building that type of thing. So,
well, yeah, I think there's a number of factors, obviously, that drive that, and they're both personal and I think economic in many ways. But people want to be close to their children. They want to be close to quality health care. Many folks have retired from positions that where they are on a certain health care plan that is only exists in certain locations. So that's an important decision that they make. Many of them do downsize, certainly, but we're seeing a lot of areas where you've got people that are relocating from parts of the state where they were able to sell the home they've owned for 30 or 40 years for a huge amount of money, moved into an area where the housing prices are considerably lower, buy their dream home, bank a considerable amount of money to aid in their retirement years, and retire early in many cases, earlier than what they'd planned to. So we've certainly seen pockets of this develop throughout the state where you're close enough to these, whether it's the Bay Area or Los Angeles or what have you, where people can make that decision and move and not only benefit from it economically, but in many cases get closer to the kids that have had to move out of these areas in order to find affordable housing.
I wasn't really going to ask this question, but the company that I own pays for insurance for its employees. And when I look at the bill and I look at the coverage, I don't think when you fill out a loan application, I don't think you have a back-end debt ratio that's affected by your insurance premium. But I'm wondering if it doesn't dawn on you that you now have a bigger responsibility than ever for that cost, should it occur, because the deductibles are higher. And I don't know if anybody's ever, if we've really put a number to this, but I would think it would certainly dawn on people, you know what, I'm responsible for the first $6,000 or $10,000 out of pocket. It's got to be a consideration because it can turn into almost another house payment.
Yeah, I think most 20 years ago, 10 years ago, when you sat down, and we do business in 20 states, so we represent not the entire U.S., but most of it. When you sat down with a consumer 20 years ago, it was, what am I qualified for? And if they didn't like the number, they wanted, 50,000 more, they went to the next lender, right? Everybody wanted to max out what they can qualify for, and if you didn't give them the number they liked, you stink, and they went to the next lender who told them what they wanted to hear. I think today we're seeing that the consumer of all ages, all demographics are much more conservative than they were before. And I think obviously it has a short-term effect on the market that we're speaking about this evening, but I think long-term it's probably good, for the housing market and good for the markets. But there's no doubt that the health care is a big issue, just like other things, but the health care is definitely a big issue.
Okay. We've got about 15 minutes left. I'm just going to ask everybody to answer 3 questions. one at a time. Major concerns for 2015 for your industry?
Well, our industry, certainly in the state of California and nationwide, I mean, a lot of issues relating to the cost to build, the time it takes to get entitlements. But this state is a poster child for that, certainly. It takes longer here, costs more. Development fees of all kinds continue to increase. One of the biggest threats we're looking at right now, we've had a very successful public-private partnership in place for 16 years in this state, SB 50, that created the public school financing mechanism, which is basically a three-legged stool, if you will, where you have local bond issues that provide a portion of the revenues necessary to build schools. You have developer fees that cover a portion of that, and then the state school bonds that cover a portion of it. And over the last 16 years, that program has built something like $34 billion worth of schools in this state, and has met about $11 billion, or rather $1 billion a year, almost $16 billion impact to the home building industry by having that program in place. And it's something that was put in place back in 1998 as a result of years of a lot of litigation and fighting between builders and school districts on what the fees were to be and what the impacts of those were. So without that program, and right now it's out of money, there needs to be another school bond. We've passed 4 in this state since the enactment of SB 50. But without that, we're looking at a potential of at least a doubling of the fees that builders currently pay for schools in this state, and that's anywhere from $10,000 to $30,000 per home in many cases. And it could actually get worse than that, because if it's determined that the program, SB 50, is no longer viable, then we can go back to the bad old days, if you will, where school districts just put all of it on top of the builder, and it can just be prohibitive in many parts of the state. There are certainly areas where you can pass through just about anything, but there are many parts of this state where it really will become a feasibility issue, and builders won't be able to build homes.
Okay, thank you. Gary.
For California, which I'll,
Sure.
because we're all here in California, I think the biggest issue that I would think would be facing the housing market here from a resale standpoint would be point of sale legislation, anything having to do with taxation, trying to fix the infrastructure system by putting, lumping things onto, housing. I think, I would agree. I think, they've got to come up with the money someplace. And my fear is that they would try and look to our industry to do it.
Okay.
I would think for the mortgage banking business, and I'll do this just quick, consolidation. If you look at last year, it was about a $1.1 trillion market. It was last around $1 trillion market in 2000. So statistically, 14 is going to come in as low as it's been in about 14 years. That's a long time. If you look at the height of the market in 2003 was about 3.7 trillion. Anything below a 1.7 to 1.8 trillion is generally a slower market. So when you look at a 15 being maybe a 1.1 to 1.2 trillion dollar market, there's still too many lenders out there, whether there's still too many mortgage entities chasing at 1.1 trillion, not enough loans. So I think the mortgage business will consolidate. And that's my, for me, that's the biggest concern.
Okay.
The Fed has a very tricky future, and their balance sheet is about 4 times as large to the general economy as the average of the last 40 years. They've said that's too big. They haven't told the markets exactly how that's going to get smaller yet. So it raises a risk, which we think is a relatively low risk, but there is a risk that the markets could react when they start restoring volatility by driving up inflation expectations, and you can see a rapid rise in rates. And the market did exactly what we expected last year when we had a rapid rise in rates. The first thing that happens is sales fall. House prices don't fall. They slow, but they typically do not fall. And in the past, when you've had that kind of environment, what happened was there would be a spike in adjustable rate mortgage applications. But two things are different. In the past two time periods when this happened, 1994, 95, the average 30-year fixed rate was about 8.5%. So you could reasonably expect on the other side, rates might fall again. So you could refi out of that arm. Then in 1999, 2000, the average 30-year fixed rate was about 6.5%. So again, you could reasonably expect you could refinance out of that and avoid the payment adjustment. But today, unrealistic to expect rates would fall. And we changed the rules to underwrite ARMs so that now you have to underwrite them to the maximum rate to which they can reset in their first 5 years. So you've taken away affordability tool if rates were to rise rapidly because bond markets expected inflation.
Okay. Thank you. Sean?
Yeah, I think kind of where we are in the cycle, right? So the end of 2013 looked a lot like the end of 2005. And this year, in terms of sales volumes, with prices still going up, the beginning of this year looked a lot like 2006, with prices still going up and volumes flat and then volumes declining. Now, for all of those out there that are panicked that I'm saying it's like 2005, 2006, I'm not. We don't have pay option ARMs in the market, and I think prices are relatively okay where they are. So I don't expect, a big decline. I don't think a 10% adjustment in price would be a bad thing for sales volumes, right? It wouldn't be necessarily a good thing overall, but it wouldn't be a bad thing for sales volumes. Still, I don't really expect that to happen. We are seeing our first declines in price in about half of the major counties in California right now, which kind of makes sense with the slower volumes and rising inventories. So I think it's possible we'll see some price declines next year. But I think we'll be largely stagnant, unfortunately. Fairly low sales, fairly low price. So the thing that always concerns me most, and I'm always thinking about in the back of my head, is what is the next black swan? Because, as Nassim Taleb, if I pronounced that right, said, the one thing we should expect is the unexpected, right? And what is that?
Said the trouble with the black swan is, what did he say? Retrospectively, they were obvious. Okay, but you can't see them in advance. It's great.
I can't see, I have no idea what it would be, and I don't see one right now, and I think we're going to have a relatively flat, market, a market that, investors can still make money in if they're smart and work hard. Realtors can still make money in, but it's not going to be a boom year.
What struck me about, now that we're in October, was we didn't have follow-through because when I looked at the end of 2013, that was a pretty positive year, and all the last, say, 3 or 4 months were slower than the beginning. But usually momentum carries the day, and people aggressively do something off of that momentum and creates more. And this time, that didn't happen. So that's my problem. I look at it, okay, historically, you look at price increases from 74 to 80, 86 to 90, and so forth. They build momentum. They don't lose it. So when I heard the reasoning, well, we take a pause. Well, it's not what we do as human beings. We usually add on to what just happened because we just got an exciting result by touching one of them.
There's an income story there, though. Right. And that income story is that the people that are the general transactors, the first-timers, and the middle-income households have not seen the income growth. So when rates rise rapidly in a short time period, the only way you can, if you don't have an affordability product to carry you through, then you have to see real incomes rise at a pace that offsets the larger mortgage payment at the higher interest rate, and you did not get that.
Are we referring to the higher interest rate at 4%?
Well, but it's what matters.
It's all relative, of course.
Yeah, what matters is where you go to and from, not what the underlying level is.
Correct.
And how fast.
And what I'd want to add to that is, I think what you saw in those past cases was as you saw those increases in price, what you saw along with that, besides, the income issue is also the financing terms.
Right.
Right? So, mortgage industry, like they did in 04 to 07, they did it in the past too, is as the market got better and better, they kind of bought into that, started drinking the Kool-Aid and started making looser and looser loans. And that, I think, fed those, price increases as much as anything else. The fact that we still use the sales comparison approach to appraisal, where if any three idiots overpay for a house, that's what they're now all worth, is, still a fundamental problem. And so you get that chasing the market kind of situation in those upturns. We don't have that this time because of the regulatory environment that we're in.
Well, that's one of the things, we were invited up to Washington to be part of a panel, and it was a room full of billionaire hedge funds. And I really think that they're going to be running out of the product. Looks like let's loan to real estate investors. I mean, there are going to be only so many people with 50 houses to refi. And I think they could serve a really good market function and do safe loans by doing stated income loans to an occupant. Only that pile wouldn't start with a B, that could start with a T. And it could have a very significant impact by being a replacement or an additional financing piece. And I think they'd end up with a very safe pile of paper.
Yeah, the key, obviously the key to it is it stays at the top 10% of the market and doesn't trickle its way down to the middle class. And I think that's kind of what's in play. As I've gone to Washington more than ever before, you have the regulators, where I think for the first time, the regulators are truly looking at each other and looking at themselves. And I think they would, I'm not putting words in their mouths, but for the first time you get the feeling that they believe or see the fact that maybe there's been an overcorrection, right? And they see the fact that the markets are not performing the way they expected them to. The recovery is flattened out, and they're concerned about that. It's public knowledge now, so we could talk about it. 2 weeks ago, a group of us was in the White House, and the administration was asking us, why is the recovery flat? That's exactly what they asked us. You guys are laughing, but it's actually it's a hell of a lot better question than the ones we've been getting the last 4 years, right? So it's an improvement. For us, it was exciting to hear, because for the first time, the reality of what we've been telling them, I think they're starting to see it. So when you talk about what happened at the MBA convention with the announcement from FHFA/Fannie and Freddie with the 3% down, when you talk about Secretary Castro's comments, when you talk about the rep and warrant relief that Director Mel Watt mentioned a couple days ago, you can see the attitudes change with the regulators. The regulators are now, I believe, starting to bring that pendulum back to center, because they see that the lending community is not opening back up, and they thought it would. So in that sense, it may sound crazy, but there's something to be excited about there, because I think for the first time, the regulators are working with the industry better with the credibility we've built back over the last 4 years.
Should we be getting in the Kool-Aid business then?
Not yet.
Okay.
Not yet. It's a day-to-day thing, but I do think that is something to be it's something to be encouraged about.
It would be, I was going to say, it would be really nice to see our politicians swing the pendulum back based on common sense rather than crisis. But my guess it'll be crisis that swings the pendulum back.
And the crisis will be that the building industry can't be a participant in the economy, or
prices start to fall, and there's a problem in housing. I mean, I'm hoping that doesn't happen. I think we're going to see a stagnant, fairly stagnant market here in the near term. But I think
based on what? On affordability?
I think we're at the affordability limit. You talk about affordability using the California Association of Realtors chart, and we hit this really low number, and we should go back to there. The problem is we hit that really low number not on the loan terms that they use to calculate affordability. they were still calculating affordability based on a 30-year fixed mortgage with a relatively regular interest rate and all the rest.
Well, we hit it in '89. We've hit it repetitively. So
we hit it with easier financing. We hit it with financing that was easier because of adjustable rate mortgages, interest only, and the ultimate pay option arm is how we hit those low inflation numbers. We have a market now that is a 30-year fixed market. That affordability number you're seeing is actually a real one. Look back in that chart, it's not a real one.
Well, I'm not saying you're not correct, but if you are correct, then we are at a market peak, and that would be good news to know.
No one.
Okay.
Yeah, no.
Yeah, and
Okay.
I'm not saying that I agree with that, by the way, but in other words, what Sean is saying has got some validity. If the only reason we ever showed up at 17% affordability was every time there was Kool-Aid drank by everybody to get there, including every time in the 70s, the 80s, and so forth, there were lending policies that accommodated that monthly payment to aggressively go down.
70s, you get adjustable rate mortgages, then you talk about interest-only loans. I mean, there is those products in every one of those periods.
I would expect that to replicate unless it's completely forbidden.
Well, if I was an economist, I would say that the difference this time, as Doug said, you don't have the wage growth. You don't have the wage growth.
Okay.
And I think that's the, to me, when we sit in front of applicants, that's the missing piece, to have the market continue to go upward.
Is that likely to change? I mean,
You're the smart guy.
Well, there's a comment there that I'm going to pass.
You're the damn doctor on the panel.
The last few months have started to show real wage growth. But if you compare where we should be to where we are, that's the right direction, but we have a long ways to go.
Plus, when you get more wage growth, you're only allowed to use a certain percentage of that at a front-end ratio. So you can get one heck of a raise and not materialize into much of a payment.
Yeah, and I think equally important to all of the regulatory changes is the impact on the risk profile that mortgage lenders are willing to accept. The issue of judgment has been removed. I've talked to a number of the folks who are members of the MBA that have been in the business for a long time, and they all tell you, and these are people that are invested in their communities and things like that, that what's different for them is there's 5 or 10% of the loans they will not do that they would have done 10 years ago based on what they know about the family, based on what they know about the business community, where that person is in the business community. They'd have taken a chance on them because they believe they could make it. Right. Thinking about that's sort of how they started. But today you don't make those because you get punished regulatorily if anything goes wrong.
I think Dodd-Frank has, in its current form, has forever changed the mortgage markets. There's no doubt about it. And again, you could take that top 10% that's non-QM that the banks are just going to make to their high net worth clients. But if you take that aside, Dodd-Frank and CFPB has forever changed the psyche of the mortgage banking business.
Okay. Well, with that, we will call it an evening. Thank you for coming tonight, and thank you all for your participation. It's been a valuable night.
The Norris Group would like to thank its gold sponsors for supporting I Survived Real Estate, Adrenaline Athletics, Coachella Valley Real Estate Investors Association, Caldwell Banker Town and Country, Costa Mesa Marriott, Council of Multiple Listing Services, Elite Auctions, In a Day Development, Inland Valley Association of Realtors, Investor Experts, IRA Services Trust Company, Jennifer Buys Houses, Keystone CPA, Las Brisas Escrow, LA South REIA, LEIVAS Tax Wealth Management, Personal Real Estate Magazine, Pilot Limousine, Primary Residential Mortgage, Northern California Real Estate Investors Association, Real Wealth Network, Realty 411 Magazine, Resident Lens Photography, Rick and Leanne Rossiter, SJREI, Sunoco Corporation, South Point Companies, Spinnaker Loans, Tony Alvarez, UDirect IRA Services.